Bitcoin's been on a roller coaster this past week, swinging between $110,000 and $117,000. We'll look at what drove the swings, how Fed policy signals fed into the rally, how one major sell order caused a cascade of liquidations, and why Michael Saylor says the price should already be over $1 million. Let's talk about it here on The Effect. Hi, I'm Nate Martin, and this is the Bitcoin Effect. Bitcoin opened last week pushing toward $117,000, but the rally quickly gave way to heavy selling, driving the price down near $110,000. By midweek, Bitcoin even touched a 7-week low, touching under $109,000 before stabilizing back around $113,000 on Thursday. These swings added up to almost a 6% trading range in just a few days, reminding everyone that Bitcoin can still move fast when liquidity runs thin. One of the big sparks for the rally was Federal Reserve Chair Jerome Powell's remarks at Jackson Hole. Powell suggested the Fed could cut interest rates as early as September. Traders viewed this as bullish for risk assets, and Bitcoin briefly jumped to the week's high. But the optimism faded just as quickly. The sharpest move lower this week came from one major sell order of 24,000 Bitcoin, which set off nearly $800 million in liquidations and drove the price to the week's low. And what stands out is the imbalance. A sudden sale like this sends the price sharply lower, but when Michael Saylor announces another purchase of several thousand Bitcoin, it barely moves the needle. And that raises a bigger question. With a fixed supply, where is all this Bitcoin actually coming from? Between ETFs and corporate treasuries, you'd expect available supply to feel tighter by now. And yet, the market still absorbs these buys with surprisingly little impact. And that's where the paper Bitcoin debate comes in. The idea that there may be more claims on Bitcoin trading in markets than the actual coins that exist. If you'd like to dig deeper, I covered that topic in more detail in my recent paper Bitcoin video. You'll find it linked on screen and in the description. So why does the price feel suppressed even when we can see clearly the big demand from ETFs and corporate treasuries? Well, the missing piece is what's happening in the background. A lot of the daily price action isn't real Bitcoin changing hands. It's leverage. Traders borrow to go long, and when the market dips, those positions get liquidated. Forced selling like that exaggerates the downside, creating selling pressure that wouldn't exist otherwise. Now, on the way up, leveraged longs don't have the same lasting effect because they don't remove coins from circulation the way those ETF or treasury buys do. And that imbalance, visible demand on the surface but hidden leverage and paper claims underneath, helps explain why the market feels heavy even in the face of major buying. Institutional flows also added fuel to the volatility. BlackRock's iShares Bitcoin Trust saw almost $600 million of inflows early in the week, followed by even larger outflows only days later. Meanwhile, Strategy announced it had added over 3,000 Bitcoin to its treasury, now holding more than 632,000 coins in total. Yet even that massive purchase wasn't enough to lift market sentiment, as Strategy's stock dipped on the news. And that brings us to Michael Saylor himself. In a recent interview, he argued that if the market weren't weighed down by so-called paper Bitcoin products and derivatives, supply pressure alone would have already driven the price to well over $1 million per coin. His comments tie directly to the paradox we just covered. Real buying demand from ETFs and corporate treasuries is huge, but the price impact pales in comparison to when large sell orders instantly tank the market. Now, this isn't unique to Bitcoin. We've seen the same debate in markets like gold, silver, and oil, where layers of paper contracts and derivatives can distort the true supply and demand signal. The difference is that in those markets, miners and drillers can increase production to respond to higher prices. But Bitcoin miners can't increase the rate of Bitcoin's production. That schedule is set. And with ETFs and Bitcoin treasury companies buying about twice as much Bitcoin as miners can produce, the real question is how long the imbalance can persist before the reality of hard limits forces the market to adjust. Now, there's a lot of talk about September being a down month for Bitcoin, and historically that may be true, and some are even calling for a 50 to 70% drawdown in the months ahead. But let's take a look at the actual structure of today's market. In past cycles, retail leverage drove the crashes. Traders piled into long positions, prices overheated, and when the market turned, those longs collapsed into cascading liquidations. Now, that created a glut of supply and the brutal drawdowns we remember from 2018 and 2022. But today's setup is different. There aren't nearly as many leveraged retail longs on actual Bitcoin. Instead, the dampening force comes from paper Bitcoin and derivatives, and that suppresses upside rather than artificially inflating it. The pressure isn't on the floor anymore, it's on the ceiling. So for Bitcoin to see a 50% crash in this environment, it would take an extraordinary shock of real supply, something like governments liquidating massive holdings or Satoshi's coins moving or some other black swan event. Without that, though, the structure just doesn't support the same kind of collapse. That doesn't mean Bitcoin can't dip in September. Volatility is always a big part of the market. But the bigger imbalance we've been talking about today points upward, not down. What do you think? Leave me a comment and don't forget to like and subscribe to the channel. That's it for this edition of The Bitcoin Effect. I'll see you in a bit.